Alright, good morning everyone. So this is Financial Management, Introduction to Financial Management Part 3. Yeah. So we were looking at the previous topic was to compare the various types of business organizations or businesses. Yeah. Now we move on to the third key concept in this chapter, which is the goal of financial management. Yeah, as you can see here, the goal of financial management. Yeah, let me just do the slides here. Okay, the goal of financial management. So what should the goal of a company be? Yeah, all right, so we are looking at a company in particular, but we can also expand this to a business. Yeah, any business. It can be a sole proprietorship, partnership, or a company. Yeah, so is this to maximize profit? Okay, so profit is often used as widely used as a goal for financial management. But is the goal of financial management to maximize profit? Okay, so generally this is the understood goal, profit, to maximize profit. But the problem with profit is, do we mean short-term profit or long-term profit? Okay, so you may have a condition where you may maximize short-term profit at the expense of long-term profit, or you could have to try and maximize or increase long-term profit at the expense of short-term profit. So that's the problem with profit measure. It does not consider all profits, long-term, or all the profits. Long-term, what is considered as long-term? How long is long? So these are the issues with the measure of profit as a goal. Therefore, profit is not a very good measure of the financial management goal. Now, the second possible goal is to minimize cost. Is that a better measure than profit? Okay, the problem with cost, of course, is that it does not consider revenue. It only considers cost. What about revenue? In fact, profit is a better measure than cost because it considers both revenue and cost. But then profit is limited because it does not mention the time. How many years profit? And profit, is it for short term or long term? Generally, long term profit is preferred over short term profit. But how much do you compromise? How much would you be able to forego short-term profit for the benefit of long-term profit? So these are the issues. Okay, so we say that profit, both profit, neither profit nor cost will be a good measure of financial management goal. So can we say maximize market share? Some companies have that as a goal, market share. But do you want to increase market share at a loss? And then you would be able to increase market share by simply reducing your prices. You can undercut the competition by reducing the price. But would you be able to sustain that? You can gain more market share. You can have more share of the customers in the market. But the company would be running losses. Will that be sustainable in the long run? So this is another issue. So market share could be an intermediate goal or a short-term goal or a specific criteria to achieve, but it's not a very good long-term or overall goal for financial management of any business. So market share is also not a good measure of goal. So then we come to maximize current value of the company's stock. This is for a company. But what about if the company has no listed stock, meaning the share? Stock here means stock, shares, not inventory. Stock could be misunderstood in the context of Malaysia as inventory, but stock here means shares. Right. So do we want to maximize current value of the company's shares? This is a better goal. Better goal than profit, then cost, and also market share. Why is that? This is the reason. Current value considers all expected future profits. We say profits in inverted commas within quotation. It does not mean profit from the strict sense of accounting, yeah, but it means cash flows. Okay, so this term is very important for finance. Yeah? This cash flow is very, very crucial. Now this cash flow includes both amount of cash flow and the timing of cash flow. Yeah? So that's the difference. Yeah? It includes timing. Here means both short-term and long-term. And it also considers another important dimension, yeah, or advantage of this current value is that it considers also the risk of the cash flows. So it considers cash flows rather than profits. We'll see what are the problems with profit. Yeah? Profit is actually an accounting measure. Okay, and profit is not available for us to make payments, yeah, or make investments. Okay, and therefore profit is an impaired, if you like, yeah, measure. It's not a very good measure, yeah, of a goal. Yeah, therefore cash flow is a better measure, but cash flow is a component of current value. Yeah, current value is the goal. Yeah, so we want to maximize the current value of a company's shares, or in a general sense, if it's not a company, it can be any business. We want to maximize the current value of the owner's equity, okay, or the owner's shareholding value. Yeah. All right. Why is this a better measure? Because it considers three components. Yeah? This cash flow has three components. One is amount, the other is the timing, and the third is the risk. Okay, and we'll pick this up. Yeah, pick up on this in a later chapter when we look at time value of money. Yeah, we consider what is the advantage of cash flow compared to profit. Yeah, because cash flows have these three, yeah, dimensions. Okay, that culminate, yeah, or that result in the current value. So current value is the goal. Yeah, excuse me. Current value is a better goal because it considers cash flow measures that considers all the three dimensions, meaning the amount of cash flow, the timing of the cash flow, and the risk of the cash flow. All these will be considered in determining the current value of all cash flows. And therefore, the current value is a better measure, yeah? Arguably a better measure than all the others like profits, costs, and market shares. Okay, or market share, yeah? Okay, so that's the goal, yeah? So what is the goal of financial management? If it is a business, okay, a general business, not a company, yeah? It can be a sole proprietorship or a partnership. Then the goal is to maximize the current value of the business owners' equity value or shareholding value, yeah? If it is a company, then it is to maximize the current value of the company's shares. Alright? Okay, so the next question is, does this mean we should do anything, or we can do anything and everything to maximize owners' wealth? Yeah. So of course not. That is not the case. Yeah. So this is the same. Okay, going back to the previous question. Yeah. This is the same as maximizing shareholders' equity. Yeah. For in general terms, not only for companies but for all businesses, including sole proprietorship and partnership. Yeah. So you want to maximize shareholders' equity. Yeah, that is the goal of financial management. Okay, so coming back to this question here, does this mean we can do anything, yeah, to maximize current value? Of course not. Yeah, why? Because okay, you can't see it at the screen here. I can. It is displaying below, yeah, the boundary here, but it means okay, you of course not. Because doing anything and everything will not maximize owner's wealth. Yeah? If you do something illegal, yeah, okay, it's going to jeopardize the owner's wealth. Okay, if you do something that is unethical, for example, it is also going to jeopardize, yeah, the owner's wealth. Therefore, it must be legal, it must be ethical. Okay, whatever that you want to do, yeah, must be legal and ethical. Alright, so you cannot simply do anything just to maximize owner's wealth, yeah, because it may increase in the short term, the profit or the return, okay, but it might jeopardize it in the long run, yeah. And the idea here is that the market will be able to see, yeah, if a company is doing something illegal, yeah, or unethical, all right, and the market will revalue, okay, and we'll come to this a bit later at the end sometime in the course, we'll be looking at how the market values a company. Alright, so with that, we finish the third key component of the third key concept in this course, in this particular chapter. Then we move on to the fourth key component or key concept, which is the agency problem. This agency problem happens in a company, not in sole proprietorship. There may be agency problem in partnership, but then the agency problem will be rather less in relative terms compared to a company. Now, agency problem happens, or agency relationship. In an agency relationship, there are two actors. One will be the principal, the other will be the agent. When we say agent, the principal hires an agent to represent his or her interest. Okay, so you have two persons here. One will be the owner, the principal, who owns the business in this case, and the agent, who is the manager, the manager who runs the business. And this happens in a company. Why? Because the company is owned by many owners, and the owners may not necessarily have the skills to run the business. Therefore, they hire another person, another entity, another person to run the business efficiently or effectively. Alright, when you have two, the separation of ownership, it is owned by one person, but then it is run by another person, then you have this agency problem, because there will be a conflict of interest. You have this conflict of interest between principal and agent. Therefore, you give rise to the agency problem. Okay, when you have agency problem, there will be conflict of interest, meaning the agent or the manager may have a different interest, while the principal may have a different interest. For example, the principal, the owner of the business, wants to maximize the owner's wealth, but the agent, the manager, may want to maximize salary, or may want to increase whatever payout or benefits that the manager gets, rather than to maximize the owner's wealth. Therefore, this gives rise to conflict. Okay, it is run or controlled by managers. The business or the company's operations are run by the managers, but then it is owned by the owners, the shareholders. Therefore, there is this conflict. Okay, and this conflict, must be managed. Okay, and we look at that in the next slide. There are two types of costs here, and this too doesn't appear in full. There are two types of costs. We call this the agency cost. One is called the direct cost. This is the direct cost of monitoring your agent. You monitor your managers, and therefore there will be some costs. And whatever you pay as benefits to the agents or the managers will be cost to the principal or to the owners. So this is called the direct cost. Apart from that, you also have indirect cost. Indirect cost is primarily underinvestment. The term underinvestment. This is the foregoing of risky or expensive investments that can benefit the principal but not the agent. For example, if they do risky investments, the managers don't get the benefit from the risky investment, because if it's a risky investment, and if the investment pays off, the benefit from the investment will go to the owners but not the managers. The managers will get a fixed salary, for example, but then the owners can benefit from a risky investment. So therefore, the managers will be inclined to underinvest, invest in investments that are safe, but not risky. Safe, but they give you low return. Risky investments possibly can give you higher return, but because the managers do not want to risk it, they do underinvestment. So this is a problem. When you do underinvestment, the owner's wealth is not maximized. So this is the indirect cost. So there are two types of costs arising from agency problem. One is the direct cost and the other is the indirect cost. That's all we have time for in this video. We'll continue